Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. This weekend show being recorded live from the floor of the New Orleans Investment Conference. We also recorded a number of daily editorials, more so company updates from this conference. So everyone listening, be sure to go back on our website, podcast, YouTube channel, and Substack to catch up on all the interviews that we recorded from this conference, which quite frankly is one of the busiest New Orleans investment conferences that I've been to, and I've been coming for over a decade now. Nice to see a number of new faces here and a busy exhibit hall. To kick off this show, we're chatting with Jordan Roy-Byrne, editor of the Daily Gold. Usually chat with Jordan on a somewhat weekly, almost weekly basis to get his updates on the technicals that he is seeing in the gold, silver, and any other resource market. But Jordan, first things first, great to see you at the show, and more just wanted you to recap what you talked about when you were on stage here.
Yeah, great to see you guys in person, Corey. What I talked about, I did give my technical update, but I also talked about this at the beginning of my presentation. And I also mentioned it in a panel, is that if anyone thinks about their greatest winners in investing, they all come back to, I bought a company I liked that I thought was undervalued or a good value. I thought it could go significantly higher. And so they bought a stock, they held it for 2 or 3, 4 years, and it turned out to be a big winner. So it's 100% because they picked the right stock. So, I mean, market timing is important to some degree. The macro analysis, which a lot of people follow and has a huge following, I think because it's unpredictable. So it's more exciting to hear people's thoughts, which are just really guesses on where things could be going. But the reality is people need to ignore that, spend a little time on market timing, but spend 90% of their time on company analysis, doing company research, becoming an expert on these companies. That is how you are going to make the most money, especially in a bull market. I mean, look, there's lots of gold and silver companies. We know the macro, gold and silver, we're in a new secular bull market. We're in a correction now because we got really overbought, but it's a bull market, so it's going to continue. Things are going to move way higher the next couple of years, and it comes down to, let's see if we can pick the right companies, which will be leaders and be the best performers. I want to find the stocks that are going to go up 3, 5, 7x, and not just only 50% or 100%. So that is what I implore people to do. Spend more time researching companies and spend a lot less time listening to macro doom porn, which is so prevalent in our industry. I also pointed out, as an industry, we predicted 49 of the last 0 crashes. So the macro forecasting track record, and I include myself in that because I used to talk about macro a lot more. It's too much. It doesn't add value. Focus on the companies. And shout out to you guys in KE Report because you have tons of company interviews. I mean, I listen to your company interviews if I want an update on specific companies. That stuff is really valuable to people. People need to be listening to those types of interviews more so than the other interviews where people are talking about macro, which in most cases you can't predict it with down to a T. You just can't.
Well, Jordan, I think it's an interesting point just because you are a technical analyst by trade, and you're even saying maybe de-emphasize some of the focus on technicals in lieu of good fundamental research on the companies. You also were on the stage last night in a panel where you had a lot of great thought leaders on the stage, and you made the point that if there is a rollover in the general stock markets, first of all, like you say, nobody will know exactly when that's coming, but when it does, as long as it's not a flash crash, as long as it's just a corrective move, you still predict that money will cycle out of the general markets into the sector, into those quality companies, and that wasn't a popular view on stage. People still believe that it would pull the stocks down, so maybe speak to that. People are worried that the general markets and the AI trade is getting a little stock heavy, and that it may roll over. You still maintain that if you're in the right companies, capital flows will come into this sector.
Absolutely. And I could do a whole podcast episode on this topic, but I had a couple slides or one slide about this during my presentation. there's still very, very little money in this sector. Okay. You go back to 2008, precious metals were up for 8 calendar years. I mean, the HUI, I think, was up close to 20-fold at that point. So mining stocks have made massive moves higher. We're in a secular bull market, and we had seen, again, huge gains over the previous 6 or 7 years. And so I do think at some point we are going to have that mid-cycle cyclical bear market. We had it in 75 to 76. We had it there in 2008, 2007 to 2008 for some stocks. So at some point, maybe it's 3 years or 4 years or 5 years. I don't know. But at some point, we'll have that 60% decline in the stocks again, because that's what happens. But there's no risk of that right now. There's not that much money in the sector. I mean, a tweet from our buddy Ronnie Sturfley a couple weeks ago, he pointed out Bank of America on their findings. They basically said gold, it's really overbought now, but it's structurally underowned. Their retail client portfolios, the gold position, 0.4%. And even in institutional portfolios, it was only 2%. We're talking about big money here. It's completely underowned. And it's the same thing. If you look at the assets in the gold ETFs, divided by assets in all the ETFs, that was 8%, even higher than that, 2011. Right now, we're barely at 2%. So there's no, I don't want to say there's no money in the sector, because a lot has started to come in recent months. But there's very little money in the sector. So there's no risk of a crash right now. I just don't see it. And nobody talks about the secular bear market in bonds. You get bigger crashes, and the majority of crashes when you have a secular bull in bonds. And that's because people can sell, and there's an easy alternative. You look at 65 to 1982, there really wasn't a crash. You could say 74 to 75, but the crash actually came at the very end, like the last 3 months of that bear market. Aside from that point, it really wasn't that bad of a bear market. I know it was economically, but you were in a secular bear in bonds during that point in time. And that's why precious metals, they actually did a moonshot before that bear market. And then when the bear market ended and it recovered, precious metals were ready for their mid-cycle cyclical bear market. So I know I could drone on here a lot more about that, but it's like ingrained to everybody's psyche. Oh, crash. We're going to have another, liquidity event, we're going to have a crash at some point. Look, if everything keeps up like this for another 3 years, then, maybe we will. But here and now, there's no risk of that.
So, Jordan, back to how you analyze stocks then. If that's the most important thing to do right now. I know outside of the explorers, which I think are very hard to analyze because we just don't know what drill results will be, and that's quite frankly what drives them. If we're talking developers, there's quite a few developers out there right now. What are some of the key metrics that you look at when you value companies outside of management? We all know management, fine, but outside of management, some hard numbers, what do you look at?
Value. I'm looking for something that's good or decent and has low valuations. With respect to developers, if the project is still several years away from production, the key is to find something that is trading at a very low against its net present value. So, I use studies, or I use AI to help me estimate the net present value of these projects. And if something, let's just say its valuation against net present value is 0.1, 0.10, if that's a net present value and it's a good project and they're going to be able to advance it, that's something that in a couple of years or maybe in a year, that could be trading at 0.3 times net present value. If a producer or a company that's going to be a producer, if they're building if their valuation against net present value is only 0.2, that has a lot of room to move up. Its valuation does. And again, we're just looking at this just with the current margins. So this isn't even factoring in higher metals prices. So all these companies are different. So there's not one way to value everything. So you can use net present value of their projects. If you're looking at producers, you can do, what's their cash flow multiple, what are they trading at? And so I look for companies that are like, let's just say their price to cash flow is pretty low. If it's 3 or 4 or 5x, does this have production growth? And could this be trading at 6 or 7, 8x in the next couple of years? That's how you're going to find big winners. Find things that are really undervalued, that have potential for that value to move up. And then when you throw in the bull market continuing and margins even expanding on top of that, that's how you find 4x, 5x, 7x type of winners. So yeah, there's a lot of different things, but it comes down to knowing how to value these companies.
Well, Jordan, when you are looking at these companies, another thing that you put a lot of value on is growth itself. And you talk a lot about, we've talked about the holy grail companies where they are producers, but sometimes the best exploration stocks are companies that have the capital and revenues coming in to hit the gas. Last time you talked a little bit about unicorns, and you were talking about companies that can either bring a big mine into production or multiple mines, but then use the revenues to actually boost the expansion plans. Maybe dive into how that's not really priced into a lot of these stocks today, but over time, that's the edge you get as an investor.
Yeah, with the way things are valued in this industry, or the way the market values things, the most predictable and biggest bump comes from building mines. The market loves growth in any industry. So production growth, that is the key. And so a company going from or building their first mine or being able to have a pipeline where they can build the first mine and then they can actually use some of that cash flow to fund the build of the second mine, that's huge production growth. And you don't have the big dilution. It's easier to finance. And that's also something I'm looking at. That's a big key. And also at the same time, building a mine that has expansion potential, the project itself. So you start out, maybe the mine starts out at 100,000 ounces, but there's a phase 2 expansion where it could go to 175 or 200. I mean, it's the same thing if a project starts out at 200,000 ounces a year, and then the phase 2 is maybe this can increase to 275 or 300. I really like that because that's additional growth. Because remember, in mining, you're dying. What you mine, you consume. So if you only have one mine and you just build that and you're producing from that, yeah, you can get the bump when you're building the mine. But what happens after that? You're not adding any more value. You're actually losing value because you're mining that. So it's all about how are you growing? How are you adding value? And yes, exploration, that also factors into that for developers and producers. I mean, that's another way that you can add significant value without spending that much money.
Now, pretty much all these producers out there right now are making money. I think all of the gold producers are making money at these current levels, and a lot of the companies that have recently acquired mines, even mines that have bankrupted other companies, these companies are cash flowing out of them. Curious then if you care at all about share structure, whether who holds the shares and also warrants and option overhangs when you're looking for a 3, 4, 5x in this environment where these companies aren't going to have to go back to market, at least if the metals prices stay where they are. Do you care at all about share structure?
Well, I don't, and that's because I'm looking at later stage companies with respect to juniors. Now, if you're looking at explorers pre-discovery and maybe post-discovery if it's small in some cases, the share structure and also management and people, those things are way more important when you're at the bottom of the food chain. And the people who talk a lot about that stuff, no, it's great and it's fine, but they're talking about explorers. I do own a couple explorers, but they're advanced. Most of the stuff I do, developers, later stage explorers, developers, producers. And when you get to that point, it's about how much value they can add. I mean, just like when you're at that level, and you're looking at producer, I mean, share structure at that point, I want to say it's meaningless, but it's a criteria point that, people hear that, but then they attribute it to all these companies. Like, oh, I couldn't buy that producer. That's a bad share structure. It's about the value and how they're going to add value. And share structure is it's a tiny, minimal component of that. So again, if you're looking at early stage exploration or really small companies, yes, it matters a lot more, but I don't really look at those companies. So for me, personally, I don't think it matters.
Well, Jordan, let's also talk about the balance between gold stocks and silver stocks. We've maintained with you before that there's just not a lot of great choices in the silver universe, but you have the belief that silver could go on a pretty big run over the next 18 months. And if that's the case, there may be a lot of juice in some of these silver stocks. would you be more tempted to have the optionality factor in those, or how do you play silver stocks versus the gold stocks?
Really good question. I don't know if I have a direct answer because, as you said, with respect to the quality that I'm looking for, there's just many more in gold versus silver. And we've already seen some of the quality silver deposits that juniors own. Those have been acquired. So there's like tier one, and at that level, there's really not that much left with respect to junior silver companies. So, yeah, I would say it's more risky and it's more volatile when you're going down the silver food chain. But at the same time, looking at silver's potential, 3 times in its history when it's broke to a new all-time high and then kept running, which it's not doing now, but those 3 times it doubled in 7 to 11 months. So whenever you think silver is going to go back above 50, it could double from there in 7 to 11 months. And that's based on history. And by the way, if you look at the 45-year base in silver, that argues for the same point. So that's another thing about technicals. When you're looking, we want to see multiple things that are pointing to the same conclusion. Then the odds of it playing out like that are higher and higher. But yeah, circling back to the silver stocks, it is really difficult. Like you really need to do your homework and need to understand what you own. And at the same time, also realize there's a lot of flaws in these stocks. So, I mean, silver will make that move, and we're going to see silver stocks go crazy. But again, you have to know what you own. Like back to the first question and my initial point, really understand, know what you own. And look, it's fine if you own a junior silver company, has a couple flaws here and there, but as long as you understand what you own and what the risks are.
So back to whether it's gold or silver stocks, jurisdiction. When you're analyzing these, do you put any discounts on certain jurisdictions, even when we're talking about the advanced ones or producers, companies that are making money? Does jurisdiction matter?
Again, it's similar to share structure in that the closer to the bottom of the food chain, the more important it becomes. So the higher up in advanced stage developers and producers, it matters less and less because the mine's already getting built, it's already been permitted, and then if it's operating, everybody has an interest when it's operating. It has people in that jurisdiction, like they have an interest to keep it operating. Stakeholders, that's the word. When a project is being built, is finally producing, there's way more stakeholders. But if you're in a difficult area and you're trying to get the project permitted and approved, that's when jurisdiction matters a lot more. So again, and this is where I differ from a lot of people, I'm focusing more on producers, developers, advanced stage explorers. It matters less and less. But I will say this, just my concluding thought on this, most investors really need to understand this, how, again, these criteria points, their importance differs based on where you are along the food chain. I think the mistake that most investors make, and I see it all the time, where people subscribers email and say, I want it to be in a good jurisdiction. Jurisdiction should be one of the last things you look at. Look at the project, look at the quality of the asset, then look at the people, share structure, then jurisdiction should be like what filter things out. People do it backwards. They look at jurisdiction first when they really should look at it last. If you look at jurisdiction first, like you're cutting yourself off from so many great opportunities. And I'm just, thinking about the companies in my portfolio. They're not in Nevada or Canada or those types of places. They're in places where people, I can't go there. That's a bad jurisdiction, or they're communists now. You really need to do your research on that stuff. So I think that's, again, if you're looking at early stage explorers, which are most of the companies exhibiting at these shows, it is more important. But most investors, they make that mistake. Just look at the guys who made a shit ton of money in this space, like Rick Rule. He doesn't care about jurisdiction. He does, but he'll go anywhere if it's a first-class project.
Well, Jordan, just tying this in with some of the topics we talked about, M&A, when you see a company and you've got a thesis, and then they go out and buy a mine in a different jurisdiction, or they try to grow because they are adding another mine through M&A versus organic growth. What happens when you have a thesis, a company comes in and scrambles your eggs because they then go a different direction, or they grow in a way that maybe you weren't expecting? Or are you looking at companies that could be takeover targets, hoping that the ones in your portfolio become those next acquisition targets?
Well, when a company does that and goes in a different direction, you have to reevaluate how the company looks. You can't. The problem is you can't just stick with it. So I did sell a company that has done that recently, where they've gone in a completely different direction, and it's basically a new company, and then you need to reevaluate your thesis. When the reasons change why you invested in something, you need to move on. You need to sell and move on. The problem people make, and again, all these problems, I've learned them through failures myself. Every dumb move you can make, I've done. But the problem with most people, and again, this is myself 5 or 10 years ago, you buy something that's not really working out. The reason you bought it's not panning out, but you think, oh, well, gold will go higher, silver will go higher. That'll pull the stock up. I can just keep holding on to it. No, that's the wrong thing to do. Reevaluate it, sell it, move on, move the capital somewhere else. So now the second part of, could you repeat the second part of the question?
Well, in addition to growing by adding a mine or growing through jurisdiction, the other thing is some people in position in their companies with the hopes their companies are the next takeover targets. Do you want your companies to get taken over this early in the cycle?
It depends on the company. If you own explorers or advanced explorers, they're going to be acquired at some point. So interesting question. I haven't really thought about the timing. With silver stocks, that's really the question. I don't want to see anything get acquired here before silver makes that move from 50 to 100, but that's the risk, because it looks to me like, it could potentially take silver another 4, 5, 6 months just to get back to 50 and break out. Then you have the big move after that. You have the moonshot. So there's a lot of time here potentially where silver stocks could get taken over before that happens. I mean, that would be kind of disappointing. So I haven't thought a lot about takeovers, but that would be the one. Looking at the silver market, that's my one thought.
All right, Jordan, thanks for joining us again from the floor of the New Orleans Investment Conference. Great to see everybody here and great to see all the companies. A much fuller exhibition hall this year. So, Jordan, enjoy the rest of the show, and everyone stick around. We are going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Now switching this final segment, recording from our studio, as quite simply we just ran out of time at the New Orleans Investment Conference to record another segment. And honestly, the first couple of segments, Jordan didn't really get much into the technicals in the market. So I'm bringing on Dana Lyons for the final two segments to talk more technical outlooks for these markets. We've received a few comments and emails, people asking for sometimes a bit more technical comments. Dana is our guy for that. Dana is a fund manager and editor of the Lion Share Pro. I'll post a link to his website in the show notes. Dana, we like to start with some of the metals, so let's talk gold real quick. Gold is still in a correction. It's off of its all-time highs, but seems to be consolidating right around this $4,000 an ounce level. Got to ask you, Dana, what are your models showing you about where gold could be going here?
Yeah, I think it's going sideways. We discussed last time that you had that parabolic move really accelerated in August, September into the top in October. So that was kind of a blow-off type move. It doesn't mean the bull run is over, but kind of the, let's say, deflation of that move that we've seen over the last several weeks. That suggests to us that that phase is over. Like we mentioned a couple weeks ago, that parabolic phase is over. Now we're probably in more of a digestion phase. So you're going to have to manage risk both up and down. Like I said, it doesn't mean that the bull run is over in the long term. But here in the near to intermediate term, I think it's probably consolidation phase, digestion phase. So I wouldn't look for big moves up or down. I'd be looking for more range bound trade here.
Dana, is there any time frame we can put on that would be kind of a reasonable estimate for this correction, if it is just a natural correction, considering gold has really moved up, really took off March of 2024 and just kept moving higher and higher, and then in a way just went vertical in the last couple months. Any way that we can put a general time estimate on this correction?
Well, just a basic rule of thumb, you look at prior moves. In this case, you look at the August to October kind of burst higher. You had a move on the magnitude of maybe 2 months or so. So I would expect several months of kind of consolidation or sideways movement. We also saw, back after that big up move to start the year into April, you had a move from April into August would basically move sideways and digested that move before, again, accelerated into the recent highs. So I would expect over the next several months, 2, 3, 4 months, to expect more range bound trade here. Again, I don't think you necessarily have to go out and dump all of your precious metals exposure. We haven't. We did certainly trim some, like we mentioned, as we were getting up near the highs a couple weeks ago. We talked about on the show, you had to take some profits there into those windfall profits. But I think right now I would at a minimum avoid chasing moves to the upside, and then also on the down moves, don't necessarily, jump ship just because we're pulling back. But we are not buying aggressively into the dips just yet necessarily. In fact, we're probably less exposed from the long side than we've been really in some time in the metals market.
So Dana, considering right now, right around 4,000, it's about a, let's say, 10% correction off of the highs. But this 4,000 number, I don't even know if there's really any relevance rather than it simply being a round number, since gold was just consistently hitting all-time highs. What are some lower targets that if gold does correct more in price rather than just time that we should be watching for, that still just really validates the fact that this is just a correction and nothing more severe on the downside?
Yeah, that's right. I mean, you don't want it to just completely implode and lose the entirety of especially that post August move. So looking at GLD, the ETF GLD basically went straight up from about 305 to 405, so about $100 straight up. You don't want to lose that entire thing immediately. You want to see it hold some matter of a retracement of that. So first level really that we're looking at is down around 352 or so. We're up in the today up upper 360s. 352-ish would be the first level I'd be looking at, and then down around 330 I would like to see it hold if we did break this 350 level. But again, you don't want to see that entire move retraced immediately, or else that gives you probably more suspicion, or at least creates more of a compelling thesis that the bull run is over, and it's going to be more of a longer, more drawn out type of a bear market rather than just digesting the recent gains.
So real quick, looking at the gold stocks, then looking at GDX, that ETF, that's down about 15%. We have been commenting over the last couple of weeks how the stocks are leveraging at least a little bit this move down. There's some big gaps in that chart from early on in this correction. Anything different? Anything we should be considering in the GDX chart that's different than the gold chart?
No, very similar, I would say. They should track each other, especially in a higher volatility type of regime. Probably going to track each other at least directionally. The level we're looking at in GDX, we just held a couple times over the last week down around 68. We would be trimming or hedging into rallies up towards 73, 74 probably. Because I think we're going to digest for a while, so I don't think it's a straight shot back up to new highs. So we've got a little bit of a hedge on right now against our GDX. If we do break that 68 level decisively, I think it could be a pretty straight shot down to like 57-ish, which would be, the next real decent a decent looking support on the chart. So it's I don't know that we'll do that, but it's certainly for us. It's not out of the woods that that type of unwind does unfold.
Okay, quick comment then on silver because silver made a run over that $50 level, hung above $50 for a few days, and now has corrected right to around, let's say, $47. Again, choppy, kind of like the GDX chart. A couple people are wondering if silver is setting up a head and shoulders pattern. Can you maybe comment on that or any differences in the silver chart if you see them?
Silver's similar to gold for us. Again, you had that blow off move. Now we're in a digestion phase. Looking at SLV, that's the proxy we trade for it. You have support around 42 and then also around 40. If we decisively break that, and then we likely unwind that whole move from August and trade down to like that 35 range. Also seeing, more weakness in the miners, silver miners, than we are seeing in the gold miners necessarily. So that gives us a little bit of hesitancy. And one reason we've hedged the miners right now is because of more weakness in the silver miners than the gold miners. So SIL, for example, you're seeing key level around 66. If we can recover that, then maybe we're out of harm's way for now. If we can't, then decent chance that you're going to see 55-ish.
Okay. Dana, one more commodity market that I want to ask you about is oil. Oil still, in my eyes, is in a bit of a downtrend here. The rallies have gone to lower levels. We've seen kind of lower highs and some lower lows. Oil most recently broke down at the middle to tail end of October, rebounded quickly, and is now trending lower. And as we're recording this, is back below $60 a barrel. Any life, any hope in the oil market that you're seeing for some sort of upward momentum here?
No, you explained it pretty accurately, I think. You've seen lower highs, lower lows for some time. We had that floor in place from like 21 to 20 early this year, 2025, broke that floor, tried to regain it, were unable to, and now we're still trading down below there. So benefit of the doubt is to the downside. I would say if we can hold those lows from the early in this year, then at least we can maybe start setting up a pattern of at least, even if we're hitting lower highs, at least we're not hitting lower lows anymore, and we can start trying to establish some sort of a longer term bottom. But right now, we have no position. I'd say the benefit of the doubt is still to the downside until prices prove otherwise.
All right, let's move over to the broad averages. The S&P also going through a little bit of weakness. The last time we chatted back on October 23rd, you shared your models and you mostly said that they were holding up well. But again, since that time, we've seen a little bit more pressure on the markets after hitting all-time highs right around October 28th and 29th. Your model's changing here, Dana. What's going on with these broad averages?
We have seen some slight changes in our models, and actually really occurred since the last time we spoke. Our models, again, our main model has been, bullish. It's been on a buy signal since, I think late April or so. And during that time, we were, heavily, had heavy long exposure, especially during that second quarter, and then into towards August when we started raising some cash ahead of some tough seasonality historically, and some of the sentiment just got a little bit over the skis. So we did raise some cash then, but with the thought that we'd be redeploying it more aggressively around now, which we started to a little bit, but just a couple of weeks ago, right after we had spoken, really, we've been noticing some deterioration in our models, some deterioration in some of the internals and some of the breadth statistics that we track and compute. So we are seeing a little bit more weakness, a little bit more, some more red flags than we had been seeing it, which has us has had us trimming some profits, and since we spoke a couple weeks ago, and actually recently put on a little bit more hedging exposure. So our model's still on the long side, still in a buy signal, but certainly threatening to turn to reverse lower. So we are less. We've been less eager to be buying the dips than we have been for the last 6 months or so. Again, we do have the strongest seasonality of the year coming up really from here to the end of the year. But certainly the market data is more important than seasonality, and we'll keep monitoring, our models and the market data that feeds into them, and which should give us a heads up whether or not, you should jump all in on that seasonality, or if we might see, a kind of like we did in the third quarter where the market kind of defied the negative seasonality. We'll see if we maybe defy that positive seasonality at the end of the year. But we have seen some more warning signs from our models of late.
What about leadership then, Dana? You know how I always like to talk about rotation if we're seeing that, but even more importantly is leadership. Usually looking at the big tech names, but what are you seeing out there in terms of leadership that is really, I guess, moving this market to the downside, or if there are any pockets that are doing well even as these markets fade?
Yeah, I think in the longer term, I think you still are seeing the leadership in those tech names that you mentioned, still poised from a longer term perspective for further upside, and to maintain that leadership mantle. But if we are poised for a correction in the near term, things that are up the most probably get hit the hardest, which is why, in bad days recently, we've seen, those tech names, those tech sectors leading the way to the downside just because they have more to give back than most of the other sectors. So, from a relative strength perspective, they haven't lost that leadership mantle, but from a risk perspective in the near term, certainly they have more risk laid in them right now if we do see a correction unfold. But there are other pockets of strength. I think some of the more defensive names, utilities, have held up pretty well, and then probably the one that we've liked the most over the last month or so since we started talking about a new leadership. A new leadership example would be the biotechs, which continue to hold up well, hitting new highs. And even in some of this rough patch recently, we're seeing some of our biotech stuff still sitting at new highs, and kind of shrugging off of some of that market volatility that we've seen.
All right, Dana, I want to move to the bond market as well now because yields have broadly been moving lower. The 10-year was below 4%, but recently in the last really week and a half to 2 weeks has started to rebound. But you can still make the argument that yields broadly are in a downtrend, which means money is going into bonds. What's your outlook for where yields go from here? Is this rebound more than just a rebound in a downtrend?
I think for us, the benefit of the doubt still to the downside in yields. We did hold what I would say is the most significant support in both the 10-year and the 30-year, right where we bounced. So we have been long both the 10 and 30, took some profits at those support levels, yield support levels. And in this retracement just over the last week or so, we have been adding back some long exposure in the bond market. So for us, benefit of doubt is still to the upside in prices, downside in yields. And if those levels that I mentioned do decisively get broken, we could see pretty sizable further extension to the downside yields.
Final market, then, one we haven't talked about in a little while, Bitcoin. I want to move over to the cryptocurrencies because it wasn't long ago that Bitcoin was over $120,000. Now it's corrected pretty much right down to that $100,000 level. Depending on what time frame chart you're looking at, I think you can still make the argument that Bitcoin's in an uptrend, but you look at the short term, well, then it started to fade a little bit. So where do you stand on Bitcoin, cryptocurrencies broadly right now?
Yeah, and if you're going to invest in or trade this asset class, you got to be prepared for some volatility, and kind of widen your volatility expectations. So I think you accurately described the market as well, this market as well, and that we are still in an uptrend. I think Bitcoin and both Bitcoin and Ethereum testing some key levels here, down near 100,000, just below it in Bitcoin. I think if we hold this level, we could be poised for another breakout extension of the bull market, even more potentially, even more potential upside in something like Ethereum, which did go up and test earlier this year, tested the all-time highs set 4 years ago, kind of bull flagging or consolidating over the last, um, I guess, probably 3, 4 months. So still not negating the up move or the uptrend, more or less just consolidating, working off some of the overbought momentum that it had into that. But I'd like to see it again. Also, like Bitcoin testing some key levels that we have been looking for since it did make the highs down here around 3,400. So if you are long and you want to see that breakout, another extension, a new up leg in the Ethereum bull market, you want to see these levels around 3,400 hold. And then if we can decisively get back up above 4,000, 4,100, that sets the stage for the next test of all-time highs and eventually a breakout and potentially a new up leg to the bull market.
All right, Dana, as always, thank you so much for diving into these markets for us. And there you have it, everybody, a bit more of a technical look at the precious metals, oil, and the broad averages. We even threw Bitcoin in there. A lot of good information from Dana, and I highly recommend you check out the Lion Share Pro website, where you can follow along with how Dana's trading these markets and the opportunities he sees. So Dana, thanks for taking time with me on this weekend show. And everyone, thanks for tuning in this weekend. Please go back through our website, podcast, YouTube channel, and Substack account. Just search The KE Report. That's where you can find all our daily editorials and company updates we recorded throughout the week. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.